I've said it before, but in my opinion, the fortune tellers of today are the pundits who take all of the vast amounts of data that are out there and make predictions. The reality is I could take the data on the self-storage industry that's out there right now, and I can make predictions in any direction I wanted to go about the future of self-storage using the data. But with all the data that's out there, it's really hard not to be making guesses and interpretations about what the future of storage looks like for the balance of the year. So let me share with you my ideas of what the balance of 2020 is probably going to look like in the storage space. My name's Mark Helm. I'm the author of Creating Wealth Through Self-Storage, and I'm the creator of the Quick Start Academy. And what I do is I support the small investor who wants to get in the self-storage business or who wants to grow their self-storage business, strategically do so in a way that creates true wealth and a fulfilling career. And one place that we can look at to get a lot of data are REITs. REITs are a publicly traded company, and much of their data is public. So we can get that information a lot easier than we can some other data in the storage industry. I also pay particular attention to the REITs and how they're doing, simply because in our company, part of our exit strategy is to have a portfolio that REITs would buy. So I'm constantly monitoring what they're up to and how they're doing, because at any given moment we may need to exit out of some of our properties. So Public Storage on August 6th had an earnings call. And on that call, they predicted that for the balance of 2020, their income was going to go down a little bit more than it had gone down in the second quarter of 2020. So compared to 2019 earnings, Public Storage's second quarter earnings were down 2%. And they expected for the balance of the year it to be down another 3%. And actually that's kind of right in line with our portfolio. In our company, and I'm talking about the stabilized properties, not the properties that are in lease up in our portfolio, but our stabilized portion of our portfolio, we were down 2.7% compared to last year through the end of July in our earnings. Interestingly enough, a lot of that difference in our portfolio came from late fees. Now, if you remember, we couldn't or didn't collect late fees the last half of the first quarter of this year and most of the second quarter, and just recently have we been able to institute and put back in late fees and start having auctions again. Usually for our company, late fees really only account for 2% of our income in our stabilized portfolio and our stabilized properties of our portfolio. But in the difference between earnings in 2020 and 2019, the difference in the late fees accounted for 20% of the difference in the earnings. And again, this is not surprising given that the majority of the year so far, we've been unable to collect it. But why would we think that earnings would be down another 3% over the balance of the year? Well, one thing to note is operating costs. Public Storage had a 6.7% increase in their in-store operating costs between 2019 and 2020. Now, fortunately for our portfolio with the stabilized portion of the properties, we've actually been able to reduce our operating expenses 4.7% between 2020 and 2019. One of the benefits of being a little smaller company is we can move quicker and make changes quicker. So we've actually been able to notice a drop in our operating expenses for the stabilized portion of our portfolio, which is made up to a large degree on the income loss that we're having. Now, I only see operating expenses going up. Public storage, their increase in operating expenses was primarily due to increased marketing costs and increased property tax costs. For us, we're seeing the same thing. We're having to spend the cost of a new lease for us is going up dramatically, and we're battling property taxes in many of the locations where we currently are right now. And I only see the operating expenses going up over the balance of this year. Now, for the other REITs, the numbers were very similar. Extra Space, in-store revenue was down 3.1%, and their NOI, net operating income, was down 4.6% from same time period last year. So we're talking about 2020 being down over 2019, but let's keep this in perspective now. We're going through a pandemic that is a once every 100 years type of thing that we're going through right now. And in the background landscape of the storage space, many of the submarkets are overbuilt or moving towards being overbuilt. So given that backdrop and the current situation with the pandemic, being the numbers we're talking about, 2%, 3%, 4%, those are not down by much. I wonder how the retail sector's doing compared to the self-storage sector. How would you like to be in the office space right now? I think you'd be very pleased with a 2.7 decrease in income 2020 over income 2019. That's why there's still a large amount of money, capital, going into the self-storage space. I thought that the cap rates would slowly be going up, which equates to lower sale prices, but cap rates have pretty much held their own. Now, with all that we've said about public storage being down 2020 over 2019, so far this year, they've closed on $67.1 million worth of self-storage, and they have in their sights or under contract another $33.3 million left to close that they know about this year. The self-storage space still has a lot of capital flowing into it right now. So in our company, we're working hard to keep our operating costs down to compensate for any shortfall in revenue. And we still have our eyes open for value add plays in secondary markets. In our humble opinion, that's where the opportunities lie. In secondary markets, there's still sub-markets that are underserved where you can do a value add play and put more storage into service in some of those markets. Just know that your lease up time is going to be longer, and the rents that you'll be getting in the lease in the new space don't necessarily equate to the rents you are currently getting in the existing stabilized space. Be sure to write in more concessions, and we're using a lower rent number. Used to be we would take the income on the stabilized property, and that's what we would use to project on the expansion. We don't do that anymore. So be careful, but keep your eyes open. Thank goodness we're in the self-storage space and not in some of the other sectors like office or retail. Storage is a fantastic product to be in when times are booming, and it's probably the best product to be in when times are tough. So thank you very much. My name's Mark Helm. I'm the author of Creating Wealth Through Self-Storage, and I'm the creator of the Storage World Analyzer. That's the financial analysis tool that we use to project the future cash flows of a project we're looking at acquiring. If you're using Excel, great. We use Excel, still do, but we use the analyzer every day as we look at properties. It creates great reports, and if you're not using it, I really invite you to look at it. StorageWorldAnalyzer.com or CreatingWealthThroughSelfStorage.com. Click the Storage World Analyzer tab. Thank you very much, and I look forward to being with you next week. And I'll see you then.